Look at Intuit. And Intuit, I know this is a company you like to use. We use it here as well. We use the QuickBooks portion of it. And I know you're a big TurboTax guy.
TurboTax. I use TurboTax. I have a lot of people that I work with that use TurboTax. I also have people that, have CPAs or enrolled agents or whatever it is, and that's fine too. But I think TurboTax does just fine for some people, not everybody.
Yeah, and it looks like a lot of people are using TurboTax, and the shares.
I believe it.
the stock climbed nicely last week, about 8% actually, after the company reported a rosy full-year outlook for the upcoming year here, and Intuit expects adjusted earnings in the range of $20.07 to $20.12 per share, which was actually up from its previous guidance of about $19.16 to $19.36, and analysts were looking for about $19.40 in earnings per share. So, that was definitely a strong beat in terms of that outlook for Intuit. And again, I think a lot of it is, they have a great market share. Their products are fantastic. I know we use the TurboTax, we use the QuickBooks.
I like QuickBooks too. Yeah, QuickBooks is really easy to use.
It's amazing, especially if you're getting more small businesses. If you're getting that growth as an economy, I would assume this company would be a benefactor.
Yeah, it's very intuitive for Intuit.
I'm assuming maybe that's why they called it that, but I don't know why they call it Intuit. But anyways, let's look at the numbers here for Intuit. Their ticker symbol is INTU. They are in software application. Not much short there. It's about 1.4%. This is my concern with it. I hadn't looked at Intuit in a while, so I thought, hey, maybe it looks interesting. But price to earnings, 61.4 times. Very expensive there. The industry is expensive too at 87.9. Even price to sales, 11.7%. That's above the industry of 7.3. Price to tangible book value, I don't know. I assume perhaps they've gone through a lot of acquisitions. Price to tangible book value, 238.6 times. Again, the tangible assets essentially on the balance sheet. And price to cash flow, obviously expensive as well at 34.2, above the industry average of 33.5. Reason why I think it's potentially expensive, the growth's been good. Over the last 1 year, earnings were up about 13.2%, sales were up 15%. But over the next 5 years, they're looking for earnings growth of about 17.6%. So, that is a good grower. The question is that valuation worth that growth rate?
That's an extremely high number, 61%. And I like Intuit, but how could they possibly be growing that much to grow into that? I've talked to people, and a lot of people. TurboTax is the standard as far as tax prep, but there's other ones out there, and I know that some people are shifting to those things for whatever reason. And I think if you're somebody who does TurboTax, you probably do it every single year, and every year that I've bought it, the price has pretty much been the same. So I know that they're not getting extra sales that way. So that means they've got to be getting new people, or they've got to be getting new business owners or something like that that are using their QuickBooks products.
Yeah, or they're expanding products. So I know sometimes on QuickBooks they have you can, put cash in here in this QuickBooks account, which I've never wanted to do that. I feel like, we bank with Chase. I feel very safe with that. And especially with our business banking, I want to make sure that we have good safety, good liquidity. We can access that money as quick as possible. I'm not saying maybe QuickBooks has a bad bank account there, but I feel much safer with Chase at this point in time. But maybe to have ancillary services that they're starting to offer, that's one other way that they can continue to grow. But you're absolutely right. I think Cash App, which is owned by Block or Square's, what the company used to be called, I believe they also offer tax planning or tax services, tax filing services online now as well.
Yeah, I know that there's a couple of them, Tax Act or something, Tax Slayer. I don't know. There's different names.
Slayer.
That might be not it. I don't know.
That'd be a good name. It'd be funny. But yeah, it's a great point about how is this company going to actually grow at that growth rate. If you own the stock, I haven't gotten the target sell price yet, but I'm going to assume it's going to be way overpriced. You'd want to know how this company is growing because you need that growth to justify that valuation so far. Kind of funny here, we talk about the low dividend for Regeneron. Same dividend yield for Intuit, 0.6%. They do have a higher payout ratio, though, at about 32.5% of earnings and 19.3% of free cash flow.
Makes sense with the super high PE ratio.
Yeah. And the thing with them, too, is they have the cash flow for it to even increase it further if they wanted. But again, if you have that high valuations and you're supposed to grow that much, returning capital to shareholders many times is questionable in my opinion because you're trading at such a high valuation. You need growth. Mm-hmm. Returning to shareholders might actually cost you long term if you can't then turn that money into growth. And I'm kind of surprised by this. They buy back about 1.1% of their shares over the last year. I mean,
Why?
trading at that valuation, it's like you should be looking, again, for external options for growth rather than buying your own stock at a valuation that high. I
Definitely.
just,
Yeah.
your hurdle rate's got to be immensely high to buy back your own stock.
Yeah, and I mean, wasn't very much, 1.1%. I think
Yeah.
you said not very much. But you're right. I mean, the dividend and the buying back shares, it seems like you would want all capital going to try and increase the revenue or branch into new markets or whatever it is.
Yeah, and I will say sometimes companies like this buy back their stock to offset stock-based compensation, so that could be a reason for that. But again, another thing you want to dig into, balance sheet for Intuit, very good. 1.5 is the current ratio, so plenty of liquidity. Debt to equity, 0.4, so not much debt on the balance sheet. Great profit margin here, 19.1%, above the industry of 10.9%. Current price for Intuit, $753.47. The 52-week low is $532.65, and the high here, $759.50. Year to date, the stock's been a great performer, up about 20.3%. Over the last 5 years, up 174%. Over the last 10 years, wow, up 677.5%. So, I mean, Congratulations if you've held into it. You've definitely done very well. The stock's been a great performer. As always, though, the question is, do you continue to hold it going forward? Because obviously, it might not do 677% going forward over the next 10 years.
Looking at the price to earnings, I would be shocked.
Yeah. And I was going to try and see here. I'm having some issues on the technology side to see what those future earnings are. I'm assuming they're not going to be great. Yeah, July 2026 estimated earnings per share is $22.86. I mean, that gives us a target sell price here of, trying to do some quick math, $379.48. I mean, forward PE is still over 33 times. And earnings growth, why we said is good. I mean, it's about 18% this year, 13% next year. I mean, there becomes a point where that earnings growth becomes so challenging that it becomes harder and harder to justify that high valuation on Intuit. So
I like the business, maybe expensive.
yeah, I agree with that. I continue to use the service, but I don't think I'd recommend the stock at these levels. It'd be one if it went on sale, I'd absolutely jump on it. I think it's a great company, but
yeah, it's got to have. I mean, the cash flow is very consistent with them. If you use QuickBooks, you're not changing likely because it's a pain to change. And same with TurboTax. If you're used to it, you can buy it at Costco, you buy it on Amazon. It's very convenient.
Yeah, and I think the hard part is with them, and I don't know the numbers exactly, but I think during tax season their revenue spikes, so it's almost like they'll find out if they had a good year in that one quarter. If they have a bad quarter, well, then their whole year is going to be bad. So you do have a little bit more, I'm going to call it timing risk, than most other businesses. I mean, I guess that's kind of true for retailers as well during the holiday season, but
for them, up until April 15th, that's got to be
that's what we got to crank out.
Yeah, that's going to make or break the year is how that goes.